It's nearly Friday. I'm Nino Kafara. I'm a solicitor, and this is Talk Legal with Nino. So, how can you reduce your inheritance tax liability? Well, the first point is you're not actually going to pay it because you're going to be dead. It's a bill for those you leave behind, and it comes out of your estate. And your estate is made up of everything you own: your home, cash, personal possessions, the dog. There's no inheritance payable on the dog, but you might want to mention who gets the dog in the will. Now, you don't pay inheritance tax on all of your estate. Everyone can give the first £325,000 inheritance tax free. If you own a property and you leave it to the kids, your tax-free limit increases to £500,000. For married couples, that's double, but not in all cases. So imagine you're married, your home is worth £1 million. That can go to the kids tax-free, usually. Everything else is taxed at 40%. So if your joint estate is, say, £2 million, maybe you've got investment property, cash, savings, the second to die, their estate is going to pay inheritance tax of £400,000. But before your beneficiaries can get their hands on anything, HMRC want their money first. How do you reduce the liability? Well, firstly, you can borrow money. Now, that's not everyone's cup of tea, but by borrowing, you're reducing the net value of your assets. But if you keep the money, the estate value doesn't reduce. So you've got to get rid of it. For those of you who have watched Brewster's Millions, you'll know that it's hard to spend money without actually accumulating something in return. I mean, you could spend it on holidays, restaurants, but that might take some time. You could gift it, say, to your kids. The only catch is you have to make sure you live 7 years after making the gift. If you die before that, there's some tax to pay. And remember, you'll be dead. So now the person you gave it to has to come up with the cash. You could make regular gifts out of income. That's immediately inheritance tax free, subject to certain criteria. So, for example, if you've got rental income, that might be for you. Don't give it away if you think you might need it later. Once it's gone, it's gone. You could invest in inheritance tax friendly investments. Some investments become inheritance tax free after just 2 years, but you'll need to speak to an independent financial advisor for that. There are lots of other things you can do, but the bottom line is you have to do something because the value of your assets are increasing, usually, especially property, and you're getting closer to death with every passing second. Just think, when you started watching this video, you had an additional 2 minutes and 55 seconds to live. That's 2 minutes and 55 seconds of inheritance tax planning time gone, but at least you've used it wisely. Now, how long does it all take? Well, it takes a lifetime, and you really ought to start planning as early as possible. It's never too late to do something, and it has to be reviewed regularly. Get some advice from someone who specializes in this area of law, not someone who does it on the side. If you thought that was useful, hit the like button. For more interesting stuff on death and taxes, just hit the subscribe button.